This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Hi. In this lecture, we're taking a look at a couple of issues which I regard as current. Be clear, there was a time in the examiner when the examiner would test things like exposure drafts enthusiastically about new standards that would be coming in the future. That doesn't happen now. So by current issues, I mean just a couple of things that are sort of recent. The first one is materiality. Just to remind you that there is a practice statement on materiality, again, which has been published by the IASB, and it's suggesting best practice when we consider what things are material in the accounts. The problem has been caused because companies are over-disclosing information, a bit like politicians. So they tell us too many things and then they hide the bad news in amongst the good. It's difficult to see the wood for the trees. So recently, they changed the definition of material. The one that I grew up with was something would be material if you omit it or misstate it, and that could change a decision of the primary user of the accounts. Now, first of all, does primary user mean employees? No. Does primary user mean the government? No. Primary users are the providers of finance. So, for example, the shareholders, the lenders. So, traditionally, we've always said that if you miss something out or misstate it, then, and it would change a decision of an investor, it's material. But because of this concern about companies hiding information, the definition now includes the word obscuring. So if you obscure something by over-disclosure, then actually you are doing something that's materially wrong. A classic instance is something like IFRS 8 operating segments. The business, perhaps it's, you might argue that it's got 50 segments. And then if you start disclosing revenue, assets and profit for all of them, no one can see the wood for the trees. So when the business puts together its financial statements, it's a 4-step approach. And I'd recommend that you learn the 4 steps. Decide what might be material for the primary users. So that's really saying, well, in all of the accounting standards plus local legislation, what is suggested that should be disclosed if it's material. Then step 2, is it actually material or not? Most of you will be familiar with the concept that something might be material by size, just as a percentage of profit, or by nature, if, for example, it was a director's transaction or something that would affect a loan covenant. Having decided what's material, make sure you then present the information clearly and concisely, like this part of the notes in a sense. And then finally, stand back at the end like an artist. Look at what you've produced and say, is there anything else I should add in or delete? So that's the practice statement on materiality. I'd recommend you learn those 6 points. Also here, the examiner indicated that you should be able to think in a scenario question about how many accounting standards would become relevant in the event of some disaster, global catastrophe. The most recent, of course, the thing that inspired this was the COVID epidemic, again, at the start of the 2020s. So a scenario question could present something of that nature, some catastrophe, and say which standards would be relevant. I've listed standard numbers here. You don't need to list the numbers. No one is impressed by standard numbers. They're not interesting. What matters, of course, is not the number, but the rule. The mummy and daddy of everything, of course, would be to ask yourself, in the event of something like a pandemic, is the business a going concern? That's IES 1. Remember from your audit studies that there are two levels of going concern. At one extreme, you've got the company that is completely insolvent, finished, gone away, kaput, nothing left whatsoever. In which case, if the company is insolvent, they'll have to do the account on a breakup basis, so everything would get written down to realizable value. If, on the other hand, they're not yet insolvent, but there are uncertainties, think about the impact of the pandemic in the 2020s on the hospitality industry, hotels, restaurants. If they face uncertainties, then those uncertainties must be disclosed. You don't need to do a breakup basis unless you are almost or actually insolvent. You wouldn't use breakup basis just to indicate uncertainties. That wouldn't really be true and fair. Other standards of relevance. Well, inventory, that's an easy one to understand, IES 2. If you're selling fresh food and no one's there to buy it at the moment or can get to you or whatever, issues about NRV and cost, not a problem. In the pandemic, various governments decided that they would support businesses, for example, through a furlough scheme, and therefore IES 20 comes into play. That's, remember, all about matching cost and benefit. So if the government is giving you something to support your workers for 2 years, then we need to make sure it hits the P&L over 2 years and not immediately. We talked a minute ago about going concern. In less extreme circumstances, of course, IES 36 becomes relevant, and that's impairment. So even if there are no going concern indicators or significant ones, it may still be that within the business, one part of the business is now impaired, and as a result of that, that bunch of assets will need to be prospectively again written down. So it will be a chance for you to explain your basic impairment rules, the fact you have to compare the carrying amount with the recoverable amount, and again, losses going into the profit and loss. Remember what happens? You split the business up into cash generating units. In the last pandemic, then a number of retail businesses were moving online. So the retail part of the business would be impaired. Because they had the foresight to move online, it doesn't mean, though, that there were going concern indicators. There's no doubt, though, that something like a pandemic will trigger multiple redundancies, unfortunately, hence IES 37 provisions. So our regular rules there about redundancies, reorganising the business, the fact that you only recognise the provision once you are committed to a particular plan. So you've told the staff that they're going to be leaving again, and you've got a proper plan as a board of directors. Finally, bad debts are a fact of life, perhaps more so if everyone is struggling. That's IFRS 9, isn't it? Bad debts you need to write down, but I suppose we should use the posher language, and that's to say, we need therefore to recognise expected credit losses, so we need to write down the receivables in respect of those, again with any loss going directly, normally, to the profit and loss account. So bad debts would be another consideration. There we are. There's a review of some of the standards that would be impacted in the event of some unfortunate global event. Thank you.